You know, when most people think about finance, they think about one thing, betting if a stock will go up or down. But what if I told you there's this whole other world? A world where traders, they bet on chaos itself. Today, we're going to dive deep into the wild world of trading volatility, and we're using Colin Bennett's classic text as our guide.
Right, so like I said, most of us think about trading in just two ways, right? You're either long or you're short, up or down. But what if there was another way? What if you could make money not from where the market is going, but from its mood, from its level of chaos, or its complete calm? That's the huge question we're going to unpack.
Okay, so how on earth do you even do that? Well, the first crack at it used a tool you probably heard of, options. But here's the trick, right? The real genius was figuring out how to use them to bet on the movement, the pure movement, and get rid of all the risk of whether the market actually went up or down.
And the key to the whole thing was the strategy called delta hedging. So what is that? Look, in plain English, it's just a way to make your position totally neutral to the market's direction. You're constantly buying or selling the stock to perfectly offset your option. It's like you're canceling out the noise of up or down. And what's left over when you do that? A pure, clean bet on just how much the stock moves. That's it.
And this is what it looks like. This graph shows you that hedged position, and traders literally call it a smile. You can kind of see why. See that red curve? That bottom point right in the middle, that's where you start. Now, if the stock price moves, and I mean really moves away from that point, doesn't matter if it's up or down, you start making money. You don't care about the direction, you just care that it moves. A lot.
But, of course, there was a catch. And it was a big one. This was absolutely not a set-it-and-forget-it kind of deal. To keep that position perfectly neutral, traders had to be on it, constantly, tweaking, re-hedging, every time the market moved. This whole process, they call it gamma scalping, it was a nightmare. Super labor-intensive, and all those trades, the costs would just chew up your profits. It was clear they needed a better way.
Yeah, that constant, expensive hedging was a huge headache. So, what happens when there's a problem in finance? The market innovates. They came up with something new, something more elegant, designed from the ground up just for trading volatility.
And that's where the swap comes in. Think of it like this. Instead of building this clunky machine out of options and stocks, a swap is just a direct agreement. It's a contract between two people. One person says, I'll pay you a fixed rate for volatility, say 20%. The other person says, great, and I'll pay you whatever the volatility actually is. It's just a clean, direct bet on how much the market is going to move. No more of that constant, painful hedging.
Okay, so these swaps, they came in a couple of different flavors. The first one, the volatility swap, is pretty straightforward. The payout is just based on the simple difference. If you agreed on 20% and it comes in at 21%, you get paid on that 1% difference. Simple. But the market pretty quickly moved on to something way more powerful, the variance swap. Now this is key. Instead of volatility, the payout is based on volatility squared. So why on earth would you square it? Well, think about it. Squaring the numbers gives a ton more weight to those really huge, crazy market moves. It makes it a much better, much more accurate way to capture the real chaos of the market.
And this really gets to the heart of why variance became the gold standard. A variance swap's payout isn't path-dependent. What does that mean? It means it doesn't care how the market got from point A to point B. It could have zigzagged like crazy or just moved in a straight line. Doesn't matter. All that counts is the total deviation, the total movement. And that purity, that simplicity, made it the perfect tool for the job.
But of course, traders being traders, they didn't stop there. Oh no. Once the variance swap market was up and running, they built the next level, another layer of abstraction. They started trading options on variance. So let that sink in for a second. You're not just betting on how much the market will move anymore. You're betting on the volatility of volatility itself. We're getting deep now.
And once you get to this level, this vol-of-vol world, a lot of the normal rules you might know from regular stock options, you can just throw them out the window. Everything gets flipped completely on its head. The way these things behave is just weird. It's super counterintuitive.
Just take a look at these two charts. They really show you how strange this world is. So on the left, you've got something called positive skew. Now, normally in the stock market, everyone's afraid of a crash, right? A big move down. But here, the bigger fear is actually a sudden explosion of even more volatility when things are already wild. And then on the right, you see this inverted term structure. All that means is that traders expect any big spikes in volatility to be really short-lived. They're pricing in chaos for today, but they're betting on things calming down later. And both of these things, they are the exact opposite of what you'd usually see in the stock market.
So at this point, you're probably thinking, okay, this is fascinating, but it's some super complex niche financial engineering. Why should I care? Well, here's why. It turns out that these products, as niche as they seem, can have a really big, tangible ripple effect on the stock market that we all watch.
It all comes down to this really powerful feedback loop. Let's just walk through it step by step. So step 1. A bunch of big clients sell variance swaps to the dealers at the banks. Okay, so now the dealers are long variance. They'll make money if the market gets choppy. To hedge that new risk, they sell a bunch of options. Now, here's the really critical part. Because of how those options hedges work, if the market has a good day and goes up, the dealers are forced to buy stocks right into the market close, and if the market has a bad day and goes down, they're forced to sell. So what's the result? Whatever the market was already doing that day, their hedging just pours gasoline on the fire, pushing it even further in that same direction.
And that brings us to this incredible, powerful irony, doesn't it? The very financial tools that were designed to let people trade and manage volatility can actually end up creating more of it. Instead of smoothing things out, they can amplify the market swings.
And that leaves us with a really fascinating and honestly a kind of unsettling question to think about. When the tools we create to trade the market's behavior actually start to change that behavior, well, it just blurs the line, doesn't it? It makes you stop and wonder, who's really in control?